In video 7, we're looking at how credit rating agencies look at credit risk. So the way that most of the agencies evaluate the quality of bonds with regards to their credit risk is they give them a rating. So in this table we can see that Moody's rates that their highest bonds are AAA, but their terminology is a capital A and two smaller A's, whereas S&P again calls their bonds AAA, but their terminology is three capital A's. And you can see that as we kind of go down the table, they have lower and lower credit quality. So AAA being the highest quality and a very small risk of default. And then as we go down, the quality diminishes and the risk of default becomes higher. Triple C, according to S&P, or a CAA, according to Moody's, is poor quality and clear danger of default. And below that, it's highly speculative, and a D for Moody's is in default, or a dash for Standard & Poor's. Again, the bond will be in default. And so if we come back to this graph that we saw at the beginning of the video series, we can see that the lowest yield that's required is obviously for a government bond, because we believe that these bonds are risk-free. That is, that the government will always pay on time and pay in full what they've promised to pay. And you can see that that blue line is at the bottom of the graph, and it has the lowest yield of any bonds. Then you can see AAA, there's a spread over and above what the government has to pay for any corporate bonds, because there's a risk that these bonds may in fact default at some point. But AAA is obviously the highest credit quality, and so it's the next lowest line. And then as we go up in terms of the lines, those bonds have lower and lower credit quality. And the very top line you can see will be a BBB bond, which on this chart has the highest default risk and hence requires the highest rate of return. So what's the history been in terms of corporate default rates? Well, Standard & Poor's has a cumulative average corporate default rate, and they looked at a period from 1981 to 2009, and it shows the probability of default for particular bonds with the credit ratings. So, an important note here is this is the probability that the bonds in fact default, not the probability that the bonds may get downgraded to a lower credit rating. So we call that the probability of transition. This particular table is just purely looking at, do the bonds actually default over a particular period of time? And we find that for AAA rated bonds, there haven't been any bonds in that period of time that have actually defaulted within 1 year of being rated AAA. And only a very small percent, 0.39%, have defaulted in a 5-year period when they were AAA rated, and then only 0.82%, 10 years, and over a 15-year period, only 1.14%. So very, very small rates of default. And then again, they're quite small rates of default as we go down to, say, BBB, BB or B, we can see that the default rates are getting higher. Again, relatively small in a 1 or 5 year period, but getting considerably bigger over a 10 and a 15-year period. And if we're looking at CCC or C, we can see that there are significant rates of defaults within these bonds. Now remember, default does not necessarily mean we get zero money back. It just means that we don't get paid what was promised at the time they said we would be paid. So we may in fact have a reasonably good recovery rate, and so our loss may not be huge, but it's not what we were promised to be paid. And so it's important to consider how risky these bonds are. And the other important point to note is that default rates over time are not constant. From the graph on the right, you can see that there have been 3 periods in particular where the default rate of bonds over the past 30-40 years has increased significantly. So you can see that from 1981 all the way through to 2009, the overall default rate on speculative debt was only 4.4%. But we can see that in 90 to 92, it was 8.5. In 1999 to 2003, it was 7.1. And then again, it reached 9.2 in 2009. So clearly, when the economy is in trouble in a recessionary type period, or just a downturn, then the rate of defaults in bonds increases significantly. So it's important to note that default rates aren't constant throughout time, and that defaults will often cluster at particular time periods depending on how the economy is performing. Now these tables look at the transition rates, and so what this means is how likely is it that a bond which is currently rated AAA will still be AAA in, say, 1 year, as in the top table. The bottom table, we're looking at a 7-year period. So how likely is it that a company that was AAA at the beginning of the period, 7 years later, is still AAA rated? And so this shows you how likely it is that a firm will stay at the same level of credit quality over these different periods of time. And you can see how they change throughout time. And you can see that some firms will, in fact, be downgraded over time. And obviously, as a firm gets downgraded, we would require a higher rate of return. So a credit analyst role is similar to that of an equity analyst, but obviously we look at slightly different characteristics. The benefit of a credit analyst is that often you can have a security over particular assets, so you've got more likelihood of making sure that you get paid what you expect when you expect. But obviously with a credit analyst, there's a limit to what you're going to be able to get, because you don't have the upside that, say, an equity investor has. But as a credit analyst, one of the key things is the character of the issuer. So what's their ethical reputation? What's their qualifications? What's the operation record of that board of directors, management, and executives responsible for the borrowed funds? So how ethical are they? What's their reputation? And do they have a history of always paying on time? Because critically, as a debt investor, that's what you care about. They've promised to pay you a specific amount at a specific time. Will they do it? That's the key thing that you're interested in. You're then also interested in, well, what's the business model? So are they acquiring? Are they expanding? How aggressive is the firm? Are they taking on too much debt? Is the business model robust, or is it under threat? What's the company's ability to be able to repay in the future? What's the changes to the company's strategy? Is it moving along in a fairly steady way, and so you're comfortable knowing what they're doing, or are they making significant and frequent changes? So the stability of the firm, again, is important, whether they can repay the debt. Are they retrenching people? Are they restructuring? If so, why? What's that mean in terms of their ability to repay you? What's been the history of their performance over time? What's the organisational resilience? So are there key person who, if they were to pass away, become sick or leave, would that leave the firm vulnerable? How significant is that? Or is it a deep management team? What's the compensation for the management, and how aligned is it with shareholders? Is it excessive? Is it poorly aligned? Does it incentivise too much risk? As a debt holder, you don't want the firm to take on too much risk. What's the management turnover? How stable is the team? So there's many different factors that as a credit analyst you really want to look into to understand a firm. And once you get an understanding of that, you can figure out, okay, is this firm going to be able to pay? Do they have the capacity to pay? What's the quality of the collateral that is pledged against the debts? And then finally, what are the covenants? So how much protection do we have as a debt investor to make sure we get paid what we want to get paid? We also do a lot of analysis as a credit analyst. So we're going to look at ratio analysis. So what's the short-term solvency ratio? So this is the type of analysis we covered in week 1, where we're looking at liquidity ratios, looking at coverage ratios. We looked at leverage ratios to just see, can the firm meet its obligations in the short term? Can it afford the interest in the long term? And can it afford that level of debt in the long term? We also want to do analysis on the cash flows from the operations. That gives us good signals as to how much cash they have and the flexibility in the cash and their ability to be able to continue to pay the obligations that they've made to us, and how sensitive they are in terms of any ups and downs in the marketplace or market cycles. We also want to look at that cash flow relative to capital expenditures they're making, and can they afford to continue to invest in the firm as well as be able to repay us. And then as with our financial statement analysis that we've done for equities, we want to consider historical data, both 1 year, 5 years, whatever period you think is reasonable to help you with forecasting forward. Want to compare how they've performed historically with what the forecasts are looking at. We want to look at trends. Are they improving? Are they deteriorating? How are they performing relative to other companies? We want to compare short-term and long-term analysis of the ratings agencies, and then we want to obviously make sure we're making adjustments for any significant items or any kind of non-recurring or special items as well. S&P have their own particular formulas. So as we said in the first week of class, that there's often a number of different definitions that are used in industry for particular ratios. With these, you can see S&P has defined some of the key ratios that they look at. So they're looking at the EBIT interest coverage, EBITDA interest coverage, funds from operations relative to the total debt, free operating cash flow relative to total debt, what's the return on capital, what's the income relative to sales, so looking at some profitability, looking at some leverage with long-term debt to capital, total debt to capital, total debt to EBITDA, and then discretionary cash flow to total debt. So again, looking at how affordable and how affordable is it for the firm to be able to pay for all of this debt, and how much debt have they taken on. We then can see from this table we've got for 3 years, from 2001 to 2003, we can see the median ratios for the different financial ratios that S&P looks at, and we can see for each credit quality what type of ratio they were able to have. So clearly you can see that the better rated bonds have much higher coverage ratios. So AAA's got 23.8 times interest coverage relative to, let's say, a BBB has only 4.2 times coverage. And again, similar ratios for the EBITDA to interest coverage or the cash flow to total debt. The free cash flow to total debt, again, is much higher for the higher credit quality firms relative to the lower credit quality firms. And then with the return on capital, again, you'd expect that the higher capital the higher credit quality firms have much higher returns on capital,